Welcome back to course number 3, Trend Analysis. Now that you know the key levels, let us learn to identify the direction between those levels. Module number 5 is Trend Analysis. The trend is your best friend in trading. Everything we learn in this module is about identifying, following, and trading with the trend, never against it. We already covered the definition of trends in Module 1. Higher highs and higher lows for uptrend, lower highs and lower lows for downtrend. Let me add the trading rules for each. In an uptrend, only take long trades. Buy every pullback to support. Never short a stock in a strong uptrend just because it seems too expensive. That is fighting the trend. In downtrend, avoid buying. Sell rallies to resistance. The most dangerous words in a bear market are it has fallen so much it must be cheap now. Downtrends can last far longer than anyone expects. In a sideways market, buy at the lower boundary and sell at the upper boundary. Wait for the breakout in either direction before taking a larger portion. The longer the consolidation, the more powerful the eventual breakout. Drawing trend lines. A trend line is one of the most versatile tools in technical analysis. For an uptrend trend line, connect two or more swing lows with a rising diagonal line. This line acts as a dynamic support. Price respects it on each pullback. For a downtrend trend line, connect two or more swing highs. Price keeps getting rejected as it rises towards this falling line. The minimum requirement is 2 touches. With 3 touches, the trend line is confirmed. With 4 or more touches, it is very strong. The most profitable signal from a trend line is the break. When an uptrend trend line breaks, price closes below the line with above average volume. It signals a potential trend change. When a downtrend trend line breaks upward with high volume, a new uptrend may be starting. One critical rule: always require volume confirmation on a trend line break. False breaks on low volume are very common. High volume break equals genuine signal. Price channels and Doe theory. A price channel is a trend line with a parallel line drawn at the opposite side. Price oscillates between the lower trend line support and the upper channel resistance. In an ascending channel, buy near the lower trend line and take profits near the upper channel line. The most exciting signal is when price breaks above the upper channel line, called a channel breakout, which signals an acceleration of the trend. Doe theory. It was developed by Charles Doe in 1880s, is the grandfather of all technical analysis. Its core principle is markets have three types of trends. The primary trend lasting months to years, the secondary trend lasting weeks to months, counter trend corrections, and the minor trend lasting days. Always identify which level of trend you are trading before entering. Let's add our first technical indicator to the chart. Moving averages. Module 6. The single most widely used technical indicator in the world. FII trading desks, mutual fund algorithms, individual traders, everyone watches moving averages. That is why they work. SMA versus EMA. A moving average smooths out price noise by calculating the average of last n periods. The 50 simple moving average, for example, is the average closing price of the last 50 trading days. The simple moving average or SMA gives equal weight to every day in the period. It is slower and smoother, better for identifying long-term trends. The exponential moving average or EMA gives more weight to recent prices. It reacts faster to new price changes, better for short-term trading. The key moving averages to know: 9 EMA for intraday momentum, 20 EMA for swing trading. This is the swing line used by most professional swing traders. 50 SMA for medium term trend, 200 SMA for the long term macro trend. The 200 SMA is often called the line in the sand. When the Nifty is above 200-day SMA, the long term trend is bullish. Only take long trades. When below, be very cautious about buying. Golden Cross and Death Cross. The Golden Cross and Death Cross are the two most watched moving average signals by institutional traders worldwide. Golden Cross. The 50-day SMA crosses above the 200-day SMA. This confirms a long-term bullish trend. Institutions and mutual funds begin buying aggressively. Historically, the Nifty 50 has delivered 25% or more returns in the 12 months following a golden cross. Death cross. The 50-day SMA crosses below the 200-day SMA. This confirms a long-term bearish trend. Institutional selling intensifies. The death cross preceded the major corrections in 2008, 2011, and the COVID crash in 2020. Important context: these are lagging signals. They confirm trends after they have started. Do not wait for a golden cross to enter a bull market. You will miss the first 10 to 15% of move. Use them for confirmation and for adding to existing positions, not for timing the first entry. MA as dynamic support and resistance. Here is a practical insight that will immediately improve your trading. In an uptrend, moving averages do not just show you the trend direction, they act as dynamic support levels. In a strong uptrend, the 20 EMA acts as support. Price keeps pulling back to the 20 EMA and bouncing. This is one of the cleanest recurring setups in swing trading. When a stock in an uptrend pulls back to its 20 EMA on low volume and forms a bullish reversal candle, that is your entry. The 50 SMA is the institutional swing level. Large mutual funds and foreign institutions often use the 50-day SMA as their reference for adding to positions. When Nifty touches its 50 SMA in an uptrend, expect heavy buying. The 200 SMA touch in an uptrend is the deepest institutional buy zone. It only happens during significant corrections. But when it does, and when volume is high and reversal candles form, it is one of the highest probability long entries available in the entire market. Moving averages tell you trend direction. Volume tells you conviction. Module 7 is volume analysis. Price tells you direction, volume tells you conviction. A price move without volume is suspicious. A price move with volume is real. Let me show you why volume is the truth serum for the market. Why volume is the truth serum? The 4 volume price combinations you must memorize. Price up plus volume high. Strong uptrend confirmation. Institutions are buying aggressively. This is a genuine rally. Follow it with confidence. Price up plus volume low. Weak rally. Only retail buying with no institutional participation. Be cautious. This move may not sustain. Professionals call this a low conviction rally. Price down plus volume high. Strong downtrend. Panic selling or institutional distribution. Do not buy the dip here. The selling is real and may continue. Price down plus volume low. Healthy pullback with an uptrend. No real selling pressure. This is the gift. The market is pulling back on low conviction, giving you a chance to buy cheaper. This is the pullback and buy setup. The single most important volume rule. Any breakout must have volume that is at least 1.5 times the 20-day average volume. If Nifty breaks resistance on low volume, treat it as a false breakout until proven otherwise. On balance volume or OBV is a simple but powerful indicator. When price closes up, today's volume is added to OBV. When price closes down, today's volume is subtracted. The result is a running total that shows whether volume is flowing into or out of the stock. The most powerful OBV signal is divergence. If price is making new highs but OBV is not, selling is happening into the rally. Smart money is distributing. This is a bearish divergence, a warning that the rally is not backed by genuine buying. Volume profile shows how much volume traded at each price level, not just over time. The point of control is the price level with the most volume. This level acts as a powerful magnet. If price moves far from the POC, it tends to return. Low volume nodes are areas where prices moved quickly with little trading. These are price vacuum zones where moves can be very fast. Climax volume and volume dry up. Two extreme volume events are among the most reliable signals in all of technical analysis. Buying climax. After a long uptrend, there is a massive surge in volume on a very large up candle. This represents the last desperate buyers entering at the top. Smart money is distributing to these late buyers. This often marks the exact top of a rally. Sell signal. Selling climax. After a long downtrend, there is a massive volume surge on a very large down candle. This represents the last wave of panic sellers. Smart money is absorbing all the supply. Price typically recovers sharply from this point. The COVID crash in March 2020 was a classic selling climax, one of the best buying opportunities of the decade. Volume dry up. A dynamic shrinkage in volume during a pullback in an uptrend. Sellers are simply absent. There is no conviction behind the pullback. This is the setup for the next upward leg. Low volume pullback in an uptrend equals a gift opportunity. Volume tells you convection. Now let us measure momentum. Module 8 is RSI and MACD. Momentum indicators like RSI and MACD are the two most widely used momentum tools in the world. Master these and you will have a significant edge in timing your entries and exits. RSI, Relative Strength Index, measures the speed and magnitude of price changes on a scale of 0 to 100. It tells you whether a stock is overbought or oversold relative to its recent trading history. RSI above 70 is the stock has risen too fast, too quickly. Buyers are exhausted. This is the overbought zone. Do not buy here. In fact, start looking to exit existing positions. RSI 50 to 70. Bullish momentum zone. Stock is in an uptrend. Pullbacks to RSI 50 in this zone are good buying opportunities. RSI 30 to 50. Bearish zone. Downtrend momentum. Avoid buying. Wait for RSI to cross back above 50 as a trend change signal. RSI below 30. Oversold zone. The stock has fallen too fast. Sellers are exhausted. Look for reversal candles and support confluence to enter a long trade. Important nonce. RSI below 30 is oversold zone. The stock has fallen too fast. Sellers are exhausted. Look for reversal candles and support confluence to enter a long trade. Important nuance. RSI above 70 does not automatically mean sell. It strong uptrends, RSI can stay above 70 for weeks, a phenomenon called overbought momentum. Wait for RSI to fall back below 70 before exiting. The exit is when RSI crosses from above 70 back below 70. The exit is when RSI crosses from above 70 back below 70, not when it first hits 70. RSI divergence. RSI divergence is the most powerful RSI signal and one of the most reliable signals in all technical analysis. Pay very close attention. Bearish divergence. Price makes a higher high but RSI makes a lower high. Price is rising but the momentum behind that rise is fading. Smart money is selling into the rally. This is a major warning that a reversal is coming before price confirms it. I have seen bearish divergence on Nifty's weekly chart predict every major correction in the last 15 years. When Nifty makes a new all-time high but RSI is below its previous high, start reducing risk exposure. Bullish divergence. Price makes a lower low but RSI makes a higher low. Price is falling but momentum is improving. Buyers are stepping in at lower prices. Smart money is accumulating. This often precedes a strong reversal rally. Divergence on weekly charts is more powerful than daily. Weekly divergence marks major tops and bottoms, the kind that define a year's worth of returns. Daily divergence marks minor corrections. Always check both time frames. MACD is moving average convergence divergence. Measures the relationship between two exponential moving averages. It is both a trend following and a momentum indicator in one. The three components. MACD line equals 12 EMA minus 26 EMA. Signal line equals 9 EMA of the MACD line. Histogram equals MACD minus signal, showing the distance between them. Bullish crossover. MACD line crosses above the signal line. Short-term momentum accelerating faster than long-term. Buy signal. Bearish crossover. MACD line crosses below the signal line. Momentum turning bearish. Sell or exit signal. MACD above zero. Both EMAs in bullish formation. Take only long trades. MACD below zero. Downtrend dominant. Be very cautious about buying. Growing histogram. Momentum accelerating in the current direction. Shrinking histogram. Shrinking histogram. Momentum decelerating. Tighten stops or take partial profits. The best MACD use case. Bullish crossover above the zero line in a stock that just broke major resistance with high volume. Triple confluence. Momentum trade breakout equals a very high probability long trade. Combining RSI and MACD. Using RSI and MACD together eliminates more false signals. Here is the simple framework. Strongest bullish signal, RSI crosses above 50 and MACD crosses above signal line and price is above 200 SMA and price bounced from support. All four together equals a very high probability long setup. Strongest bearish signal. RSI crosses below 50 and MACD crosses below signal line and price is below 200 SMA and price rejected from resistance. All four together equals a high probability short or exit signal. The rule is single indicator signal equals speculation. Two indicators confirming equals a trade worth considering. Three or more indicators confirming equals a high conviction trade where you size up. RSI and MACD measure momentum. Bollinger Bands measure volatility. Module number 9. RSI and MACD measure momentum. Bollinger Bands measure volatility. Module number 9 is Bollinger Bands. It was developed by John Bollinger in 1980s. These bands measure volatility and create a dynamic channel around price. Once you understand them, you will never look at a chart the same way again. What are Bollinger Bands? Bollinger Bands consist of three lines. The middle band is 20-period simple moving average. The upper band is the SMA plus two standard deviations. The lower band is the SMA minus 2 standard deviations. The bands expand when volatility increases and contracts when volatility decreases. Price near the upper band. Statistically expensive relative to recent range. Not automatically a sell. In strong uptrends, price can walk the band and stay near the upper Bollinger for extended periods. But watch for reversal candles combined with RSI above 70. Price near the lower band. Statistically cheap relative to recent range. Not automatically a buy in downtrends, but combined with RSI below 30 and a bullish candlestick pattern at key support. Excellent bounce setup. Price touching the middle band. In uptrends, the middle band is the buy zone. In downtrends, it is the sell zone. The Bollinger Band Squeeze. Bollinger Band Squeeze is one of the most powerful setups in technical analysis. It occurs when the bands contract to their narrowest width in months, sometimes weeks. Narrow bands means volatility has collapsed. The market is coiling, energy is building. A big move is imminent. The direction is unknown, but the magnitude will be significant. The trade. Wait for the bands to reach their tightest point. Watch for price to break cleanly outside one of the bands with above average volume. Enter in the direction of the breakout. Target. Take a measurement of the bandwidth at the time of the squeeze. The move after the squeeze is typically equal to or greater than this width. So, the wider the squeeze, the larger the potential move. Bollinger Band squeeze followed by an upward breakout with high volume is one of the strongest signals for a sustained trending move. I have seen this setup major Nifty rallies multiple times. Bollinger Band trading strategies. 3 complete Bollinger Band strategies. Strategy 1. Squeeze breakout. Wait for the squeeze. Enter in the direction of breakout expansion with volume. Exit when price touches the opposite band. Stop behind the band at breakout. Strategy 2. W bottom means reversion. Price hits the lower band, bounces, pulls back near the lower band again, forming a higher low, a W pattern. Buy on the second bounce. Target upper band or middle band. Stop below the first low. Strategy 3. Band walk in trending markets. In a strong uptrend, buy every pullback to the middle band. Exit when price closes below the middle band with volume. This keeps you in a trending moves for the full duration. Bollinger Bands are volatility tools. Fibonacci shows you the mathematical levels where price tends to reverse. We will continue this in module number 10 in the next video.